Welcome everyone, it's Chris here. What we're going to talk about in this video is what accounting is as a field of study. Like, what is accounting? What types of accounting is there? Why do we need to study it? Why do we care about it? Who cares about accounting information? We're going to answer some of those questions, and then we're going to get right into one of the most important things in the entire course, which is the fundamental accounting equation. So let's jump into it. Why is accounting important? Well, a lot of people, you'll hear people say this, it is the language of business. So it's going to sound, it is the language of business. Let me go ahead and let that focus, and then we'll be good to go. So it's the language of business. A lot of times you'll hear people say that, and really it's because it's like learning a new foreign language, right? There's a lot of new terminology that's involved. You're really looking at the math and being able to decipher like what's going on for a company's financials by looking at their financial statements, being able to read through the notes to their financial statements. All of that definitely requires some finesse, and even though it is, definitely specific rules that are involved for accounting, it is a little bit of an art to be able to do so successfully, being able to wade through all of that information. So it is the language of business. The normal kind of typical, if you and I were talking, out at a bar or something, here's what I would say. Accounting is the formal way of keeping track of all the company's financial events, letting other people know how the company is doing. Other people being inside of the company or outside of the company, just letting them know how the company is doing. The textbook definition, this is where it gets a little bit, kind of confusing and boring, is accounting is the information system that identifies, records, communicates economic events of an org to people who are interested so they can make informed decisions. All of that is to say that it's taking information, financial information about a company, and it's trying to organize it in a way for people to look at that information and then be able to make decisions, be able to make sound decisions based on that information. Now, there are really two main types of accounting. We've got financial accounting and managerial accounting. So some classes kind of combine these two concepts. Usually financial accounting is taught first, and then you learn managerial accounting. But financial accounting and managerial accounting are kind of two separate kind of disciplines, two separate areas. And financial accounting is primarily how we, as a company, or really it's about the rules that a company must follow when they are going to record their financial information, record their transactions, and then turn them into financial statements. Like, what are the very, very specific rules that they have to follow? So really, financial accounting is primarily for external users, and it comes in the form of financial statements. So primarily for external users, they don't work for the company, but they care about how the company is doing. So this is like potential investors. These are banks, especially if they're going to give a loan, creditors, suppliers. So if we're going to do business with a company and we're going to supply them some raw materials, or we're going to supply them some goods that they are going to resell, we're going to want to make sure that, that's a good company to do business with. So it's really any external parties, not like parties like, woo, but like external users of this information. That's who we care about here. Governing bodies, other companies, even customers, they all might care about how the company is doing. So those are all going to be people who care about financial accounting information. So investors a lot of times care about the income statement. Bankers and suppliers care more about the balance sheet. And these are different financial statements that we will talk about a lot more as this class goes on. So we'll talk a lot more about the financial statements in a bit. But for right now, just know that financial accounting, mostly for external users. Managerial accounting is primarily for internal users, and there's really fewer like specific rules that must be followed. So that's like the main difference. Is financial accounting, there are like very strict rules that need to be followed, generally accepted accounting principles. So GAAP must be followed up here for financial accounting, generally accepted accounting principles. Whereas managerial accounting, if it's just inside of the company, then like we as managers can make whatever rules we want to. We want to record the number of smiley faces that are on the factory floor every day when those toys are getting created around Christmas. Then we can go ahead and do that. Maybe all the smiley faces lead to higher productivity, or whatever reason we might want to record those smiley faces, we can do so. So there's really like fewer rules. It's really more about managers, executives, employees. How do they help, or how do they get financial accounting, or how do they get financial information to help them make decisions. So it's really for internal users. That is managerial accounting. So it's going to be a lot of like profit analysis, a lot of decision analysis, things like that. All right. So now, as we move forward, we are going to talk about the fundamental accounting equation. We're literally going to use this throughout the entire class. Every accounting class that you ever have in your entire life is going to involve this, or is going to have as like a cornerstone of it, this accounting equation. So the accounting equation that is not going to go away. Our entire accounting lives, out in our careers, we're going to have to keep in mind A equals L plus equity or stockholders' equity. So you might see that as SE, you might just see that as E. I write it out as stockholders' equity because a lot of times we're dealing with corporations. So this equation must always stay in balance. So this is like any other math class. We learned this when we were in like the first or second grade, that an equation must remain in balance. Now, what people will sometimes get confused here on is they'll say, oh, that means that A equals L plus SE. If we add, say, 100 to the left, that means that we necessarily need to add 100 to the right. But what I'll say is that that's not necessarily true. That would keep the equation in balance, but there are some scenarios where we might add 100 to the asset side and also subtract 100 from the asset side as well. So that would be totally valid, and we're going to see some scenarios where that kind of thing happens as well. The key, because this is just a net of 0, right? It went up by 100, went down by 100, so the overall is 0. That's what we've got as something that's totally valid. So it could be adding 100 to both sides or subtracting 100 from both sides, but it also could just like be sometimes when something nets out to 0. So this equation, assets, liabilities, stockholders' equity, know that this equation remains in balance, but we are going to now break down each one of these individual components because, again, this class is so much made up of brand new terminology that we maybe never heard before. So assets, something that you may have like kind of heard, but don't really know exactly what it is. Same thing with liabilities, same thing with stockholders' equity. All of these are new terms and new concepts that we're going to wrap our brain around, and we're going to take it one by one. We're going to start with assets, then move on to liabilities, then talk about stockholders' equity. But just keep in mind that this equation always stays in balance. Okay. What does any of this mean? That's what we're going to talk about starting on the next page. But one thing before we do that, I want to kind of point out is that we are always the company. So people will get extremely confused in this class when you start thinking about transactions or what the company has done, and you start using pronouns like I or you or they. Okay, you can definitely do some of that stuff, but make sure that you are using we when you refer to the company. Like when you're taking the company's perspective, we are always going to be the company. And by extension, when we're thinking about the fundamental accounting equation, we are taking that fundamental accounting equation perspective of the company as well. So it's going to be very easy to get confused if you start to take like the employee's perspective, or you start to take the supplier's perspective for certain transactions. Like if we buy t-shirts that we then plan on reselling, you want to be very careful about we being the company. We are the ones buying those t-shirts as inventory to then resell them. You're just going to want to make sure that you are extremely tight about the perspective that we're taking when we're thinking about our fundamental accounting equation and what goes up, what goes down, things like that. So just keep that in mind. We are going to be the company, and I'm going to kind of start to help us flex that muscle as we move through the course. Okay, very important to remember. Okay, it's so important. I just talked about it. I literally just said it. But we are the company. Okay, we got to think about things from the perspective of the company when we're thinking about the accounting equation, not like an individual employee, not a manager, not the suppliers, not the bank. We are going to be the company. So always, anytime that you're doing a question where you're dealing with that fundamental accounting equation and things are going up, things are going down, you're going to want to make sure that you have that type perspective of, okay, which company am I dealing with? This question is mentioned a couple. So from that company's perspective, what is going up and what is going down? Okay, that's going to be the tight understanding that we have to have going into certain questions. Okay, let's break down our fundamental accounting equation. So again, we've got we've got our assets, That's what this entire page is dealing with. And then we're going to get into our liabilities, right? So we've got our liabilities there. And then we've got on the next page, stockholders' equity. So I'm just kind of priming everything right there. We've got assets, liabilities, stockholders' equity. But we are going to now take a deep dive and really understand what the hell any of that stuff actually is. So in assets, an asset, just one. Okay. So assets or an asset is anything that we own. So it's just all the stuff, all the company's resources, all the stuff that the company has. So we're going to make this, pretty simple example. Let's say that we are running our own local bar. Okay, so we've got a bar. We've set up shop on Guadalupe. We see a lot of students come in, if you're 21, but we see a lot of students come in. We see a lot of faculty come in. Let's think about that from the bar's perspective. What are the assets for that bar? So the bar's assets are going to be things like maybe they have some cash in the cash register, right? They've got bar stools. They've got tables. Maybe they've got some video games or something, right? They've got video games that drunk people like to play. They've got the building maybe that they're in. Maybe they own, like we own the building. So this bar, we are going to own that building. So it's really just all the stuff that the company has. So we've got an example of assets over here. Maybe we sell t-shirts. We buy t-shirts and we sell it with like our logo on it or something. Those are going to be considered inventory. Maybe we've got cups, plastic cups that we run through. Those are going to be some supplies that we have as assets, but it's really just all of the stuff. So some examples of assets I have listed here for you to kind of read through, but we've got cash and cash equivalents, short-term investments, something that comes up kind of, in very specific chapters in the course, but short-term investments, sometimes a company will buy some shares of stock of another company to then like resell them for more later. So that would be an asset. Accounts receivable. Okay, I'm going to come back to that in a second, but accounts receivable is a very tricky one, but really anything receivable, when you see that, you should think asset. But I'm going to explain accounts receivable and notes receivable a little bit more in depth below, because again, that's one of those new terminology kind of things that we haven't really talked about yet. Okay, so we've got accounts receivable, notes receivable that I'll talk about down below. Inventory, I'm sure that we've heard that word before, but inventory and supplies, the best way that I can describe that is, again, from this bar's perspective, supplies are things that we use up. So that would be like plastic cups. So, or maybe, for us to do our accounting work, to like, create our financial statements at the end of the year, or to like work with our accountant to make sure that our employees are being paid appropriately. We might work through some paper or work through some markers, things like that. These are going to be things that are more supplies, whereas inventory is going to be stuff that we buy that we plan on reselling. So really, I don't know, thinking about it from GPA Factory's perspective, we don't really buy markers to resell them. So really these markers that we would buy, these would be considered supplies. But if we bought some t-shirts that like had our logo on it and like we wanted to sell them to customers or give them a chance to buy them so that they could wear them and like do like free advertising for us or something, then that would be more considered inventory, right? We're buying it to then resell it. That is inventory. Now, prepaid expense accounts, we'll talk a lot more about this in future videos, but prepaid expense accounts is, if we prepay our landlord for rent for like an entire year, that's going to be an asset that's going to go onto our financial statements, because we're paying cash, but then what are we getting? Well, we're getting this piece of paper, right? This pre-access to our place, right? To our building. We're prepaying for the rent, so we have access to it for the next year, and so that's going to be valuable. That's a valuable company resource, so that's why we would say that that is an asset. We've got property, plant, and equipment. So property is really like land. Plant is going to be like buildings, and then equipment is going to be like machinery or just stuff that we plan on having around for a while. We're going to use it for typically longer than a year. Okay, we've also got intangibles. Again, future videos we'll talk a lot more about what intangibles are. This is going to be like intellectual property or goodwill, things like that. And then we might also have long-term investments as well. So stuff that we buy that we plan on holding for a while. and then resell, hopefully for more money in the future. Okay, let's talk about this idea of current assets versus long-term assets. So current assets are usually going to be listed, whether it's on a financial statement, whether it's on some internal documentation. We're usually going to keep track of all of our assets in order of liquidity. Now, what does liquidity mean? So liquidity is really how easily an asset can become cash. So cash is going to be the most liquid asset. So usually like any list when we're thinking about assets, whether it's on a financial statement, whether it's on internal documentation, but if we're listing all of our assets in order of liquidity, cash is always going to be at the top. So we'll see cash and cash equivalents, and then we start to get to ones that are almost going to turn into cash at some point very, very quickly. And really current assets, you can kind of think about that as ones that are going to last for 1 year or for one operating cycle, whichever is longer. But typically we'll say that current assets are ones that are going to last or be converted into cash within 1 year. So really some current assets, I'll kind of like go back up to this list right here. We've got cash, cash equivalents, short-term investments. This really is an order of liquidity here if you wanted to use this as a rough guide. But you would usually say that all of these are going to be considered current. Okay, all of those are going to be considered current. And then you'd think that really these are more long-term. So you can use that as a little guide for yourself as you're working through, practice questions, as you're studying. You can kind of get a better sense on what is current versus long-term by taking a look at that. And again, these are in order of liquidity. So I'll say in order of liquidity, with the most liquid being at the top, least liquid being at the bottom there. Okay. Now I did promise we're going to come back to this idea of accounts receivable and notes receivable. When you see accounts receivable or when you see the word receivable at all, I want you to translate receivable to be received. So receivable means to be received. So an amount of money, right? An account, that's really just an amount of money. So an account is an amount of money to be received. So this is money that is expected to come in soon. When we say accounts receivable, usually what happens here is we sell something to a customer, but we say, okay, you don't have to give us the cash immediately. You can pay us at some point in the future. So it's like somebody comes into our bar, right? We're still running our bar, and they run up a huge bar tab, and it's like $60 that they've spent in the course of a couple of hours, but then they leave, right? Well, we know them. We're going to keep track of the fact that maybe they always come in the next day a little bit hungover, and they pay us, what they owe us for their bar tab. But we're going to keep track that night, kind of like an IOU. You can think about it like that. But again, perspective is very important. It's the customer is going to pay us at some point in the future, pay our company at some point in the future. So it is an amount of money to be received by us, the company, right? This is money that's going to come in soon. It's going to, we're going to keep track of the fact that customer is going to give us that cash at some point in the future. So that is an asset, right? It's not quite cash yet, but it is going to become cash at some point very quickly. And now notes receivable is just a more formal version of an accounts receivable. So an accounts receivable is, again, we kind of like scribble it on a piece of paper, or we keep track of it, but there isn't like an interest rate involved. It's not really like a loan at all. We're just allowing that customer to pay us at some point in the future. Okay, a notes receivable is also money to be received. So that part is the same. To be received. I don't know how to spell I before E except after C. There we go. So an amount of money to be received, money coming in, but not necessarily soon, or not necessarily in the very, very near future. So what is different about it then? So for a notes receivable, it's just a little bit more fancy. So usually there's more paperwork involved. It's really like a loan that we're giving out. So a lot of times what will happen is a bank has a lot of notes receivable. So they give out loans, and then that's money that's going to be paid back to the bank at some point in the future. But it typically involves a formal contract. It usually will involve interest. It's basically a loan that we gave out to someone who is going to give us money in the future at some point. But again, we're going to have a very set amount of time. There's going to be usually an interest rate that's involved with this loan, but we're going to keep track of the fact in a little bit more of a formal way. And again, you can kind of think about a notes receivable as involved with a bank loan of some kind or a loan of some kind. All right, that's all the introduction to assets that we're going to talk about. So again, assets, stuff that we own, and that's just really all of the stuff of a company. So all of the stuff that a company has, and then really that's going to be equal to a couple of different things. So again, we kind of relate this back to the fundamental or basic accounting equation. We've got A equals L plus SE. And one way you can kind of think about this is all of the stuff that the company has, like who has claim to that? Like who has, rights over that stuff? Well, liabilities are going to be stuff that is, claims by other entities, right? Claims, it's really anything that we owe to other entities. Whereas stockholders' equity are going to be claims by the owners of the company. So it's really all of our stuff, assets, are going to be equal to claims on that stuff. Okay, who has, rights to it? So really liabilities are anything that we owe to outside entities. This is going to create some future economic obligation, but it's really just anything that we owe. So that's going to be the key word there, is if we owe money to the bank, or if we owe some services to a customer, or if we owe money to a supplier, right? We've purchased a bunch of t-shirts at our bar that we're planning on reselling for more, but we didn't pay cash to the supplier, right? We just got the shipment, dropped off to us, but we haven't actually paid for it. We owe that money, right? Or if we owe employees for their paychecks because they've worked for about a month, but payday hasn't hit yet. We're going to keep track of all of that stuff as liabilities. So again, that key word there is how much do we owe? So some examples of liabilities. You're going to see this word a whole lot here, but you see accounts payable, you see interest payable, income taxes payable. Really, anytime you see that word payable, that's going to clue you in that we are dealing with a liability. And kind of like the same thing from before, when you translate receivable in your mind to be received, I want you to think about this payable word as to be paid. So when you see this payable word, I want you to translate that in your mind as to be paid. Okay? So it's some amount of money. If it's an accounts payable, then it's just a general amount of money. So we're just keeping track in an account. We're just keeping track of this dollar amount that is to be paid. A notes payable is going to be any money that's going out, right? But it's, again, more formal. It's usually a bank loan. There's paperwork involved. There's an interest rate that's involved. So really, notes payable is a note or a set dollar amount that is to be paid at some point in the future. So it's really a loan. Okay, just like, and then again, here's some examples of liabilities, but the idea for right now that I want you to get down is that it's just an amount of money that is owed. Okay? Unearned revenue. That seems like it's a little bit weird because it's got revenue in the name, but unearned revenue is a dollar amount that, of like services or products or whatever that we haven't actually earned yet. So, we owe stuff to customers. So that's what unearned revenue is. We've got notes payable, you're back to the payables terminology there, but bonds payable, really anything payable, and long-term debt. All of those things are going to be considered liabilities. Now, current liabilities versus long-term liabilities. Current liabilities are ones that we owe within 1 year. So if it's an amount of money that we owe within the next year, then we're going to consider that a current liability. Long-term liabilities are ones that we will pay off outside of 1 year. So a question's usually going to tell us, but current liabilities, some ones based on this stuff above, usually you're going to think of accounts payable, interest payable, income taxes payable, salary, unearned revenue. All of these are really going to be considered current. And again, it's just when is it going to become due? Like, when do we actually owe that money? That's what's going to determine current versus long-term. Usually bonds payable and long-term debt are going to be long-term. And then notes payable, it kind of depends. It's like, on the contract or formally when the paperwork is drawn up, like when do we owe that money back, that's going to determine. So sometimes we have 6-month notes payable, which is going to be considered current. Sometimes we have like 10-year long notes payables, and those are going to be considered long term. If you force me to pick one or the other, I would say that most questions are going to deal with notes payable as long term liabilities, but it really could be one or the other depending on how long that notes payable was signed for. Okay, do not confuse these. This is a little bit of an important thing. So anything to be received, accounts receivable, notes receivable, okay? A/R, N/R, that's going to be an asset, right? It's an amount of money to be received. I like receiving money. Money being received into and put into my pockets or put into my bank account is a good thing. So we're going to consider that an asset. Now liabilities, that's going to be anything to be paid. So it's an amount of money that we owe. So liabilities are going to be accounts payable, notes payable, really anything payable that's going to be considered a liability. Okay? Do not confuse those two. People get confused about that early in this class all the time. So just do what you can to know that anything receivable, we're going to think about as an asset. Anything payable to be paid, we're going to think about that as a liability. Okay, let's get to the third piece of our fundamental accounting equation. And this is going to be a little bit confusing. So this is either money that's contributed or generated by profit of the company. So let me kind of take a step back real quick. So when we have this assets equal liabilities plus stockholders equity, remember all of this fundamental accounting equation is going to be in terms of dollars. Okay, so we've got the value of all of these different things. I'm gonna just grab a different marker here. We've got the value of, look at that, we got a green screen going. Looks like this isn't green, but it actually is. So just a green screen, looks white. It's kind of crazy. Okay. I'm easily amused is what that tells you. So we've got some dollar amount of stuff that the company has. And then liabilities represent the dollar amount of what the company owes to suppliers, to the bank. So it's just a dollar amount that is owed. So we have the dollar amount of all the stuff that the company has minus the dollar amount of all the stuff that the company owes to other individuals or other companies. And that's really how much the company is worth on paper, right? Our equity. How much is the company worth on paper? The other way that I like to describe this is a lot of people will think about buying a home. And a lot of people, you'll think about this idea of home equity might be the other thing that other way that you've heard that word before. When you think about a home equity, when you think about home equity in general, you might have like a $1 million home, right? That's the stuff that goes into the home. It's like made up of all of like the shares and the home and the land that it's on, all that stuff. That's the assets of that home. It's worth $1 million. And then there might be a bank loan where we still have $400,000 that we owe to the bank, right? That's the liabilities. And then really, of that $1 million of home, right, of that total stuff of $1 million, the owners actually have claim to $600,000 of that $1 million home. So the bank kind of still owns about $400,000. We've got $600,000 that's owned by the homeowners. That's what we mean when we say this word equity. So there's really two major sources of this idea of equity, two major components, and that is retained earnings, okay, and paid in capital. So this is usually what happens at the very start of a company. There is some paid in money, paid in capital that investors will pump into the money. So the investors, maybe they believe in the company's idea, but they're going to contribute some capital. So that's why it's called contributed capital or paid in capital. For now, just kind of know that it's common stock. This is money that the owners have provided to the company. So the owners have pumped money into the company. That is going to be paid in capital. Now, the other source of equity that might arise is when the company year to year earns profit. The company can either take that profit, net income, profit and net income we're going to use interchangeably, terminology wise, but we can take that profit and we can either pay it out as dividends. Again, a new word there, dividends. We're either going to pay it out to our owners in the form of dividends, or we can take that profit and keep hold of it to basically reinvest it in the company. So if we're reinvesting that profit, that we are holding onto and not paying out as dividends, that's called retained earnings. When we break down that word, it's kind of obvious there. Retained, we have held onto it, right? Earnings and profit are going to be used interchangeably. So we've got retained, or we've held onto it, earnings, profit for the company. So what of the company's profit did we hold on to? That is retained earnings. So putting all of that together, so we've kind of formally defined as the difference between assets and liabilities. We've done that. It's part of the company's claim to their resources. How much do the owners have claim over? But kind of putting that together into this equity tree, we've got assets equal liabilities plus stockholders' equity. So for now, we're going to break up stockholders' equity as two different things here. So when we break up stockholders' equity, it's going to be as contributed capital or paid in capital, or retained earnings. Okay, one way that we might call, or one way that we might think about paid in capital, that's usually just going to be common stock. So how much common stock exists for the company. And then retained earnings are, again, profits the company held onto. So profits that the company held onto, that's going to be considered retained earnings. Now we're going to get a lot more detailed about all of this stuff as we move forward, but that's like the introduction. That's just kind of our crash course introduction to assets, liabilities, stockholders' equity, our fundamental accounting equation. But we do get a whole lot more detailed. We get, we break down each one of those. We start to do a lot of analysis of what's going on for all of these different pieces or components. But then the last thing that I'll kind of leave you with is that the generic formula for really the balance of the ending balance in all of our accounts is going to be, our ending balance is what did we start with, right? What was the beginning balance? Plus, here's where our brains have to come in and kind of fill in the gaps, plus what makes it go up, minus what makes it go down. So I'll make this like a real world example. In our pockets, our ending cash that we have in our pockets or in our bank account is going to be, well, what did our cash balance start at for the beginning of the month or the beginning of the year, right? What was that beginning cash balance plus what made our cash balance go up? Maybe we did some like side hustle work. Maybe we got some money from our parents. Maybe we started driving for Uber, whatever. That's going to make that cash balance go up. Minus what makes it go down? When we spend money on stuff, we bought maybe too many things on Amazon, or we went out to eat a little bit too often. That's going to make our cash balance go down. So this is going to be the general format that we're going to use for the entire course, right? The ending balance for any account is what was the beginning balance plus what makes it go up minus what makes it go down. But then here is where things get just a little bit more kind of tricky or challenging, that we have to make sure that we understand, those different arrows. So that was a nice kind of introduction to accounting. So hopefully we understand our fundamental accounting equation, kind of the differences between financial and managerial accounting. But I will see you in the next video. Take it easy, and we'll see you. Thanks for watching that GPA Factory video. Hopefully that was extremely helpful. If you found it to be helpful or to kind of clarify some of that content, you can also have access to a free month of membership if you follow this link and use the code YouTube100. Now with the GPA Factory membership, you'll have access to weekly review sessions that are 1 to 2 hours posted every single week that come with practice questions to help you along with your studies, and have video solutions to those. In addition, it'll include an exam review as we get closer to the exam that'll have even more practice questions and video solutions to those given out as well. You also have 24/7 access to our question wall if you get stuck while you're studying, and you get discounts on private tutoring. So if all of that sounds great, again, go to this link and use the code YouTube100 to learn from one of the best to ever teach this course. That's me. So try it out, see if you like it, and yeah, we'll see you around. Thanks.